we find in our experiences of sales and consultation with people that sometimes one part of the couple might come, like the father might come, or the mother might come, or the husband might come, the wife might come, and we don't get all the information. And one of the reasons we showed this particular video just a minute ago, it was that it showed what happens, the power of life insurance when both parts of the couple are fully engaged, where their father, he had insurance, the mother had insurance, the mother died young, they were able to reorganize things, he brought more on, he was able to take care of his family even when he sort of tragically died. So the couple dynamic in life insurance is quite important. So what life insurance, as a product goes in the insurance company's arsenal, is the most misunderstood and often underused plan that we have. There may be a chance that your car will get smashed. There may be a chance your house will burn down. You may get flown out of here for open heart surgery. All these things may happen, but you will die. I know it's a bit of a hard thing to look, but that's just the way how it goes. So what is a life insurance policy? It's a contract between the company and the individual where we promise to pay a benefit at a future date to a beneficiary for the cost of a premium, as long as it's kept in force. Now, the role of life insurance has very unique characteristics. It's the only financial product on the market that can create an immediate estate, right? Now, what do we mean by that? An immediate estate is you've bought a life insurance policy, you've negotiated, got your everything together, you've paid your first premium, the policy's issued, you walk out of the company and get wiped out by a truck, your estate has just increased by that much. Now, no other financial product can do that. You know, you can build wealth through investments, you can do all kinds of things, but life insurance is the only one that puts everything up front, okay? Also, the life insurance rule is to preserve an estate. You may have a business, you want to have an orderly succession plan, life insurance steps in. You might have an outstanding mortgage, you may have a large estate that requires settlement of death taxes. So all these are the major roles that life insurance plays. Now, all of us generally are in the type of businesses where everything's done for us. We have our pension that comes out of our pay, we have our medical that comes out of our pay. You know, all these things are determined by someone else. So what happens outside of that? There always has to be a transitional plan, right? So this is to bring to the fore what it is that we need to do outside of work. Our bosses provide us with group insurance, but we can't use that as a part of our financial plan. Our bosses love us, but it's not their responsibility to take care of us. Oops. Sorry, hit the wrong button. So, choosing the right policy. There's always three questions that are normally asked. How much do I need? How long do I need it for? Where should I buy it? But the third question is generally thought to be easy, but it's not. Even though we are Colonial and we do offer good products, you shouldn't let that be your only thought, the only thing in your thought process. There are 5 things that you need to consider when you choose a company. First off, is that the right product for me? Is Sheldon or Jane or Andrew or Janae selling you something that you need? Okay, you may be at the end of the tether and you just might need protection for less expenses, pay for your funeral and the outstanding debts. You may be young with 2 small kids and have a mortgage. So if Sheldon's trying to sell you a $500 a month investment policy and you've got 2 small children and a mortgage, you need to chase children out of your house because he's not serving your needs. So you have to make sure you have the right product. The second thing is the company that you deal with needs to have a strong financial outlook. I can tell you that Colonial, we do take in over $300 million in premium income per year. We manage over $600 million in pension assets. And we're operating 5 different places, different jurisdictions. So these are things that you need to know because life insurance and investments are long-term prospects. There's things you want to know about 20 years, 30 years down the road. Then there's a claims regime. Companies should have a good claims regime. If you die, you want to make sure that it's paid. With Colonial, we do have a mantra that once we get the death certificate, we pay within 10 days. That's how we do it. Customer service. If you're calling me or Aaron and we're not answering you, we're not returning your emails, and you're paying us $500 a month, what are we going to do to your beneficiaries? You don't want to deal with somebody like that. And last of all, price. Right? Even though things are price-driven, price is the bottom-up thing from this. Price is the last thing on the list that you should look at. Okay? How much do I need? Well, that's always up to you. We normally would sit down with our customers and find out what it is that they have, what it is they're trying to protect. Like I say, get your demographic. Are you married with 2 little kids, a big house that has to be paid for, a car note? All these type of things come into conversation. So you would know from that conversation what you would need. What you can afford is another thing, right? If you need $750,000 of insurance, but you can only afford $300,000, well, you buy $300,000 because insurance, if you can't pay it, you don't have it. Yeah. So, that's another thing. And how long do I need it for? Well, back to the small child and the house. If the house has a 30-year mortgage, you need at least 30 years of coverage. If this youngest child is 2 years old, well, before that child gets out of the woods, you're expecting her to go to college or whatever, you need just 23 years. So these are the things we look at. Anybody have children? The rising cost of raising a child. This is a very old graphic. 6 years old, right? In year 2000, it was just under 170,000. This is from 0 to 18, right? That's what it costs in the year 2000. 10 short years later, it had gone up by just about 65, 70%. So, this is from the CNN company, so this is probably America or North America. So these prices probably can have a little padding to them if you consider Bermuda, right? So that's another way we find out how much insurance we need. Things like this, we do studies. So I talked a bit about mortgage protection in the scheme of things. Let's just talk a bit about mortgage protection. What is mortgage protection insurance? It provides you an amount of insurance that's equal to your mortgage that will cancel your mortgage at death. Okay? Why should you choose mortgage life insurance? Are you leaving someone to pay your debt? Do you have small kids? Can your family afford paying the mortgage without your income? Do you have enough life insurance to cover the mortgage? How many more years are left? All these things are real crucial. And I mean, your mortgage, purchase of the house is one of the biggest, most responsible things you will do. I remember a guy telling me, now don't look at the price of the mortgage, just look at what you can pay. Because getting the amount of money to pay for a house will make you swallow very, very hard. $500,000, well, okay, in 20 years you're going to pay this back to us, right? And you say, well, how, right? So you get that part figured out, but what happens to your little family if something happens to you along the way. That's where we come in. You use our money to protect that. Okay? If you are concerned about your family's ability to continue, you need to consider mortgage life insurance. Alright. So this is a couple of the policies. Okay. Hi, Ben. Daryl, right?
Yes.
As you see. Okay, so life insurance, really, there are only two types of life insurance. There are different variations on those two types, but there are only really two types. Term insurance or temporary insurance, or permanent insurance or whole life insurance. Term insurance is normally bought in large amounts for a small price, generally bought for a specific reason, like mortgage, or if you have a loan for business, or if you are a young family and you need a lot of insurance, but you don't have a lot of money because you're putting them both through school, one's in daycare and one's in Mount Agnes, and you got a $3,000 a month mortgage note. So you don't have a lot of money for insurance, so you use term insurance. Okay. One of the distinct advantages and features of our life insurance policies is the terminal illness. If you are going to die within a year, you could actually claim the insurance while you're alive. That's really a morbid proposition. However, one of the worst things that happens is you leave it to someone that you consider to be responsible to take care of your kids, to take care of your business. And when that happens, that person car just broke, or one part of the house just fell off. So the $500,000 that you're leaving them to take care of your little kids, it's now in their control. So this is where something like this here, you can set up stuff while you're alive. We've had documented cases within our organization where we had a young woman with 2 small children, and she was diagnosed as terminally ill, and we paid her the money, and she was able to set up things for her kids while she was alive. So she knew it was done when she died. So like I said, so it's a morbid proposition, but it puts you in a position where you are able to control your assets. Another feature of term insurance or temporary insurance, it can be converted to permanent insurance. Right, so that same family, you might not like the idea of paying insurance temporary, which means that at some point in the future it's going to go and there's no return from it. You can convert it. As your life goes on, you get better at your job, you get paid more, you get promoted, and you're able to pay, and maybe your bills come down a bit, you're able to pay more. You can use your term insurance, turn it into a whole life insurance, and have other benefits. Okay, like I said, it covers for a specific period of time, and also if you were to move countries, you can take it with you. We also have the advantage at Colonial that we can write to insurance in US dollars, so it automatically becomes an international policy because it's in an international currency. Whole of life is permanent insurance, and like term, it has the same terminal illness feature, but the coverage is for life. It's not going to stop at some 10 years time or 5 years time because you only bought it for that period of time. It's not temporary, it's permanent. The benefits are credits approved, there's a guaranteed death benefit, and it has cash surrender values that can be used in your future financial planning. And if you needed money, you can use it, you can access it, or you can use it to secure loans. All these are different features and benefits of permanent insurance. These are some of the riders. If you were looking at the shows we were showing earlier, they actually talked a lot about the different riders that the people had bought. Accidental death benefit. Even though the lady had lived 2 years after her accident, they determined that her death was still caused by the accident. so they still pay the death benefit, the accidental death benefit. And generally that's twice as much. So if you had a $500,000 policy and you were killed by an accident and you had an accidental death benefit rider, you would be entitled to $1 million. It doubles. Okay? And as I just talked about the accelerated death benefit, the terminal illness. In the second, but I'll show it later. The lady, she was terminally ill, and she had 2 policies. They had stuff they had to do, so they were able to get an advance from the policy and do it while she was still alive. Okay, and premium waiver. This was another thing that they had in the little shows we showed, that was able to pay the premium for them because she was disabled, and for more than 6 months, after that period of time, the disability waiver came in and that paid the premium for them. So even though they were unable to work, they were able to pay their insurance and preserve their dream. So what's the process of buying life insurance? Okay, well, I'm sure one of us will tend to call you and get you to come in and talk to us, and we'll give you some life insurance quotes. After that point, once you accept it, you'll complete the application. Depending on the amount of insurance, your age, or various factors, you may have to undergo medical exams. We tend to do it right in our office here. And then it's underwritten. So it's not automatic. Life insurance is not a right, it's a privilege. You have to qualify for it, okay? And hopefully after all that is done, you'll get a policy. When we do the application process or the process of buying life insurance, we have to act in the utmost good faith. You bury me fide is the Latin term for it. Not caveat emptor. Caveat emptor is let the buyer beware. We don't play that game. You bury me fide, the utmost good faith. There's a high degree of good faith required. One of the things with life insurance, you may be paying a small amount of insurance, insurance premium for a large amount of insurance, right? And we need to know what we ask you. There are reasons we ask you those questions. It's not to get into your business. We're not going to spread it around the world. We're not going to put it on Facebook. It's we have to make a proper calculated assessment of your insurability, and so we ask those questions, and it's important to give us a complete and truthful answer. And in the couples dynamic, if the other party of you is planning on maybe giving us a few fibs, it's very dangerous to be less than forthcoming with the life insurance situation, because when things happen and they go wrong, and if everything is not right, well, it becomes a big problem, like benefits can be withdrawn. So it's just very important to remember that. Don't take it personal. It's we have to have a proper information to make a proper assessment. These are the factors that the underwriters would consider: the amount of life insurance, the current state of your health, hereditary diseases, the lifestyle. If you are every month you're off to New Jersey to bungee jump, it may not be a good idea. Occupational risks. Believe it or not, something we come up against very regularly in Bermuda is with the police, prison officers, and firemen. Is like the waiver of premium I talked about a minute ago. Many times they won't issue it to them because they're the type of job that they have. So these are little things. When you think of occupational risk, you think of somebody that's rigging steel or painting the radio towers, and those are risks as well. But I have a couple of pilots on my books, guys who drive planes, and local Bermudian guys. No extra rate or anything, but we just need to know. If we didn't know, then we can't allow for it. Okay, and then country of residence. generally in the West, in Europe, South America, these places are generally safe. If you're going to be moving to the Middle East, certain places like Israel is probably safer than Afghanistan. So those type of things might require, you might get exclusions. All these type of things. And there's also a financial side to it that the underwriters consider. Okay. If you earn $300 a week and you're trying to buy $3 million of insurance, underwriters can say, well, I'm just going to pay for this. So we might have to have other questions. You might earn $300 a week because that's what you want to do, but you might own 6 houses and with 2 apartments in each house, so you might be that well off. So you would have to disclose that so we know that this is not somebody that is just trying to become more valuable dead than alive. We can brush a little bit on estate planning. Estate planning is another crucial thing in a couple's life. You know, you've been married for so many years, you've built up, you bought a house, you've got this, you've got some savings, you've got this and that, and you might have to do some estate planning. We play a role in estate planning, but we don't play a major role, right? We play the part of protect. The biggest role in estate planning is served by an attorney, right? So if I talk to you about estate planning, be prepared if you want to talk seriously about it to go to an attorney, okay? It involves looking at your assets, your liabilities, your dependents, and what you would like to do to achieve for your family after death. Consider the estate planning tools available, given your personal circumstances, and lay out the costs and benefits in the context, the objectives for your overall strategy, okay? What are the tools? A will is a necessity. Without a will, the Succession Act 1974 will determine who benefits and to what extent. So your favorite brother that's been a pain in the neck, that owes you money, that this and that for the last 20 years, if you don't have a will, it might just go to you because it's the only living relative. A trust may make sense for long-term estate planning, complicated family dynamics, high risk of business assets. This is stuff lawyers will handle very ably, okay? An enduring power of attorney is available to ensure someone can manage your property affairs should you become incapacitated. So you know how you have you might be alive, but you might be on iron lung, or I don't even know what they call it now, life support, right? So life goes on, and your estate is still alive, so it has to be taken care of. One of the good things about Bermuda is that only Bermuda dollar assets are considered taxable. So if you have Bermuda dollar assets, you can buy US dollars, keep US dollars put your money in a US dollar account, and it becomes not taxable at this time. Okay. Lifetime transfers of assets. Sometimes people pass their house on to their kids while they're alive to reduce the tax implications. Life interest, joint ownership, all these type of things need to be talked about. But that's where a lawyer is crucial. This is a major part of the Bermuda law. The Bermuda advantage is that you have a family homestead designation that came in about, I don't know, 10 years ago. And so that means your house that you live in is removed. You have to apply for it, but it's removed from the asset base. So you're not taxed on your house if that's your primary family homestead. Okay. And then life insurance is another other thing that we use, and pre or post nuptial agreements. You all heard of that in the all the stuff that comes on TV. But there's really a part of estate planning in a big way, and especially with people with lots of money. These are just some of the rates, and Bermuda is considered a low tax or tax-friendly jurisdiction. Well, if you are under 100,000, they'll give you a pass. If you have 200,000, the first 100,000 is free. The next 100,000 is going to cost you $5,000. The next 800,000 is 10%, that's $80,000. So if you have $1 million, the initial tax is $85,000. Right. If you have 2 million, it's 85,000 plus 150,000. And over 2 million, it goes at 20%. So as you can see, it adds up. The thing to consider is that you have write-offs, like the family homestead, if you had money in American dollars, or if you have American property, all that type of stuff doesn't really come into, that's used to reduce the size of your estate. You may leave a lot of it to your surviving spouse, or to charity, and as I said, the primary family homestead. So these are all things you talk about closely with your lawyer.